The doji is one of the most misunderstood candlestick patterns. For example, 1. Do you know there are 4 types of doji and each has a different meaning to it? Most traders never figure this out. 2. The most textbook teaches you that a doji represents indecision in the markets. But do you know it can also alert you when the market is about to reverse? 3. Depending on the length of the doji, it could tell you what the market is likely to do in the near future. This is important. Now, don't worry if you don't have the answers to these questions with regard to the doji pattern. Because in this post, I'll reveal the answers and teach you everything I know about the doji candlestick pattern so you can finally trade it like a pro. What is a doji and how does it work? A doji occurs when the market opens and closes at the same price level. It means the market is undecided as neither buyers nor sellers are in control. However, there are variations of doji with a different meaning to each of them, which I'll cover later. For now, here's how a standard doji looks like. On its own, a doji is a neutral candlestick pattern. But, if you take it into context with the earlier price action, you'll have a sense of what the market is likely to do with the doji pattern. For example, if you spot a doji in an uptrend, it means the market is temporarily in equilibrium. Once it rested enough, the market is likely to move higher since that's the path of least resistance. Here's what I mean. But don't make this mistake. Here's the thing. Most traders spot a doji in an uptrend and think, the trend is about to reverse, time to go short on this doji candle. Bad idea. Why? Think about it. A trend is made up of prices that have been moving higher. How likely is it to lose against an individual pattern, like a doji? Making sense? I will now show you the type of doji that signals the market is about to bottom out. Number 1. The Dragonfly Doji. How to tell when the market is about to bottom out. Before I continue, you must know that despite the Dragonfly Doji being the standard doji candlestick, you'll rarely get an ideal Dragonfly Doji where the price closes exactly where it opened. Instead, you'll get a variation that has a small body with a long lower wick, and the meaning is the same. What's important is not to memorize the pattern but understand the meaning behind it. If you do, you'll never have to memorize a single candlestick pattern again. A Dragonfly Doji occurs when the opening and closing price is at the same level but with a long lower wick. It's a bullish doji and here's how it looks like. This tells you when the market opens, sellers came in and pushed the price lower. However, it's not long before the buyers took control and fought their way back higher. And finally, the market closed at the same price where it opened. This is a sign of strength as the buyers are in control. And here's how you can trade the Dragonfly Doji. How to trade the Dragonfly Doji in a range market. You know support is an area where possible buying pressure could come in. So, what you want to do is go long when the price comes to support and forms a Dragonfly Doji. Why? Because the market is telling you it has rejected lower prices and it could reverse higher. Here's what I mean. How to trade the Dragonfly Doji in a trending market. In a strong trend or healthy trend, a doji candle is likely to bounce off the moving average. Thus, you'll look to go long when the price does a pullback towards a key moving average and forms a Dragonfly Doji. Here's an example. Now, you've learned what the Dragonfly Doji is and how it works. In the next section, you'll learn another type of doji that signals the market is about to reverse lower. Gravestone Doji. How to tell when the market is about to reverse lower. A Gravestone Doji occurs when the open and close is the same price but with a long upper wick. It's a bearish doji and here's how it looks like. This tells you when the market opens, buyers came in and pushed the price higher as the doji candle closes. However, it's not long before the sellers took control and fought their way back lower. And finally, the market closed at the same price where it opened. This is a sign of weakness as the sellers are in control. And here's how you can trade the Gravestone Doji. How to trade the Gravestone Doji in a range market. You know resistance is an area where possible selling pressure could come in. So, what you want to do is go short when the price comes to resistance and forms a Gravestone Doji. Why? Because the market is telling you it has rejected higher prices and it could reverse lower. Here's what I mean. How to trade the Gravestone Doji in a trending market. In a strong trend or healthy trend, the market is likely to bounce off the moving average. Thus, you'll look to go short when the price does a pullback towards a key moving average and forms a Gravestone Doji. Here's an example. Long-legged Doji, a rare candlestick pattern and the meaning behind it. A long-legged doji is a standard doji candlestick that occurs when the open and close is the same price but with a long upper and lower wick relative to the earlier candles. Here's how it looks like. This means the market is undecided after a huge expansion in volatility, which usually occurs after a big news event. You'll seldom see this candlestick pattern, but if you do, expect volatility to die out for a while before it picks up again. So here are two techniques to trade the long-legged doji. 1. Fade the first test. After a huge expansion in volatility, the market needs to take a break before it can continue. Meanwhile, the market is likely to be in a range to accumulate orders before it breaks out. This means you can long the lows, or short the highs, of the long-legged doji, ideally on the first test. Here's an example. AUDJPY weekly, a long-legged doji. AUDJPY daily, an opportunity to short the highs on the first test. 2. Trade the breakout. Now, if the price has tested the highs/lows of the long-legged doji multiple times, then it's likely to break out. So, look for a buildup to form as an entry trigger and trade the breakout. Here's an example. AUDJPY weekly, the market went into a range after it formed a long-legged doji. AUDJPY daily, a buildup at resistance that led to a breakout. 4-price doji, how to tell if you should stay out of the market. A 4-price doji occurs when the open, close, high and low prices are the same. It's essentially a horizontal line. This means that the price did not change at all during the period of a candlestick. It's common to see the 4-price doji in markets where trading volume and liquidity is extremely low. Now, if you see many 4-price dojis on the chart, stay out of this market. Because liquidity is so low, you won't be able to get in and out of your trades easily. And there won't be any meaningful patterns for you to trade in this market condition. Conclusion. So here's what you've learned. A doji represents indecision in the markets as buying and selling pressure is equal. A dragonfly doji is a sign of strength as the buying pressure overcame the selling pressure. A gravestone doji is a sign of weakness as the selling pressure overcame the buying pressure. You can trade both the dragonfly and gravestone doji in a range or trending markets. A long-legged doji presents strong indecision, and the market is likely to be dull for the next few candles.